What's up, friends? We got a lot to get into today. We're going to be talking about Adobe earnings. They absolutely smoked their earnings, crushed it, but didn't really move much yesterday. It moved a little bit today. We're going to be talking about Oscar, the state of Oscar right now, where I see things going. We're also going to be talking about Zeta Global. Somebody else, my friend Wealthmatica, recently did an interview with David Steinberg, the CEO, as well. So now me, and my buddy Wealthmatica have both done interviews. Check those out on my YouTube, uh, linked down below for mine and his. And then finally, we're going to get into a stock that I've been buying for a couple months now. It started out as a trade, but now it's a full blown investment for me. It's a gem. It's one of my sub $10 billion market cap companies that I believe in the long term for. And its name is FLNC, Fluence Energy. Funny enough, a couple months back, I was calling out this stock to be acquired by Tesla. They didn't make the move, and they're probably kicking themselves now because this thing has been flying. We called this name out around $10 per share, and it hit a new 52-week high today. So we're going to get in that as well. So stick around, guys. Let's get right into this. Let's not waste any more time. So Adobe has been for the last 5 years down 26%. Last year down 36%. Year to date, 6 months, it's all been bad. But as we get closer to where we're at now, and where I started buying this name at just a couple of weeks ago, we're up 6% over the last month, around almost 6% over the last 5 days as well. So things are starting to look up for Adobe, and they recently had really solid earnings. You can see here in Q4, Adobe's digital media segment, including Creative Cloud and Document Cloud, generated $4.62 billion, an 11% year-over-year rise, while digital experience revenue reached $1.52 billion, up 9%. Q4 results showed adjusted earnings of $5.50 per share and revenue of $6.19 billion, exceeding expectations, double beat, and they raised guidance. Revenue grew 10.5% year over year. Doesn't sound like such a dying company to me, driven by demand for AI products. Yeah, exactly. Everybody's talking about AI killing Adobe. Meanwhile, they're integrating AI products and they're having a lot of tokenization of their products in AI. And they recently just landed, and they announced it on their earnings call, they landed a partnership with ChatGPT to start integrating some of their Photoshop and other apps into ChatGPT to basically expand their product's reach as well. And the great thing about that is ChatGPT really focuses on, I would say, the Joe Schmo. It focuses on like the normal person. Adobe's products are primarily for businesses and professionals, right? Where ChatGPT, yeah, some things are used by professionals and stuff, but the majority of things are used by the average Joe, you and me, just plugging in some things to try to make our lives a little simpler, or business people trying to make their lives a little simpler. But it's not quite there on like, creating a nice photo or editing a nice photo itself or anything like that. So that's the whole reason why I don't believe Adobe is going to die anytime soon, is because AI is not even there where you can just be like, move this stuff around in this photo and make it absolutely perfect from what I gave you. It's not there yet at all. And I don't know when it will be there, but I don't think it'll be for a while. So that's exactly why I think, Adobe's not going to die anytime soon. I think the partnership is actually a really, really good move, focusing on a different like consumer, right? Focusing on the consumer instead of these large businesses. And it'll open up, honestly, I think more revenue, and you might get a reacceleration of revenue from 10.5% year over year. They're in the range of 10-11% growing every year for the next 2 to 5 years. I think that could spin back up to 11, 12, 13% maybe, right? So things are looking really good for Adobe. They had a great quarter, blowout, $500 target. They lowered their target to 400. These analysts are crazy, honestly. Even at 400, right? We're sitting at about $350 today. Adobe's up 2% after their earnings. Did really, really well. So, by the way, guys, if you like my content, if you like these videos, if you like what I'm preaching, you can come on over here to highfivecollective.org. This is my new landing page. It kind of gives you all my social medias where you can click and follow me. on X, where I have about 38,000 followers, Instagram, YouTube, Facebook, TikTok, right? You can join our investing collective. You can join our trading collective. You know, some reviews that I've had, valuesnapshot.io. It's a brand new product that I've been working on. It's basically going to be investing research platform for me that I'm building for myself, that I'm going to give access to everybody in my High Five Collective investing tier here shortly, and something that I'm going to open up to the public here probably the beginning of next year. And I really like, and I'll actually go through some of the tools, features today, and using it to analyze Adobe and some other stuff, right? Frequently asked questions, and then just talking about the collective. So if you want, you know, go to highfivecollective.org. You can learn more about, you know, where I'm at on social media, the collective, you know, if you want to join there. But let's get into Adobe's earnings here. So we kind of already covered all of this. I really wanted to focus on right here. So we have total revenue, 25.9 billion to 26.10 billion. This is going to be FY 2026 targets. Business professionals, 7.35 to 7.4. Creative for 17.75. You guys can read it. It's on the chart. Total Adobe ending ARR, annual recurring revenue growth of 10.2% year over year. So that's what they're guiding for 2026. So again, between that 10 and 11% year over year growth for this company. And then you have total revenue for the first quarter of 2026 coming in. And these are all higher than analysts expected, by the way. Total revenue is 6.25 billion to 6.3. Business 1.74 to 1.76, 4.3 to 4.33. Creative and earnings per share 4.55 to 4.60 on a GAAP basis. And then non-GAAP general accountings principal 5.85 to 590. If we just scroll down here, we'll see basically the meat and potatoes of all this. I won't cover too much. Like, I'll stay pretty, you know, basic on this. We have a lot to cover in this video, but, you know, basically, as you can see, year ended 2025, year ended 2024, quarter ended last 3 months, 2024, 2025. You can clearly see subscriptions higher year over year and quarter over quarter. Year over year and previous 12 months, right? Products came down a little bit, right? But subscriptions are up, products down. I'm okay with that. Services and others down. But again, what I really care about is the subscription base climbing higher, right? And total revenues climbing higher, both on a quarterly basis and a yearly basis. Cost of revenue, obviously that's going to go up a little bit year over year, quarter over quarter. Product services, total cost of revenue, excuse me, obviously again climbing higher here. And if we get on a gross profit, that's increasing on a quarterly and yearly basis. Research and development, those are increasing a little bit. Nothing too crazy there. I'm not upset by the growth there. General and administrative actually coming down. So that's I like to see that. I like to see it coming down on a quarterly basis, went up on a yearly basis. Operating expensive, interest, basic net income, basic net income per share, both climbing. This company's buying back stock like crazy. I'm sure we can find the exact thing for that. Cash and cash equivalents have come down a little bit, but again, you can see that they had growth in their short-term investments. So a lot of this cash got funneled into the short-term investments clearly, as you had 273, now 1.164. And then you also had property and equipment, goodwill, total assets. Let's see. Cash flows, net income rising. Stock-based compensation, small stock-based compensation. But again, they're repurchasing way more stock. Look at this. So it went from 2.5 stock repurchase up to 2.47, or sorry, down to 2.474. Still massive stock repurchase right now. They are repurchasing stock at a crazy high clip, guys. And they're doing what Apple is doing, and it's going to drive that EPS and net income extremely high, while this company is massively undervalued. And speaking of massively undervalued, I think we've covered enough of their earnings, great partnership with ChatGPT. Overall, I would give their earnings report. Was it a knockout? Did it blow people out of the water? No, it was hey, Adobe keeps on coming in, quarter out, and beating earnings. They keep coming in, quarter out, beating earnings. They did over 10 billion of free cash flow, operating cash flows for fiscal year 2025. I mean, I give it an A, guys. I give it an A. They get an A. They're coming in. They're just a compounding machine, coming in, beating every single time. Is it some crazy oh my gosh, they just blew revenues out of the water. They blew EPS out of the water? No, but you're just getting a great compounder that comes in and quarter out and beats and beats and beats. And eventually Wall Street's going to wake up and say, okay, they're not being disrupted by AI. This is a massive opportunity, massively undervalued, and we need to get in on this thing. So speaking of that, if we come over to valuesnapshot.io, this is the website that I've been building, we'll quickly see that basically a little snapshot of everything: market cap, enterprise value, revenue, net income, 3-year revenue growth right around 10.5%. Their current PE ratio is 20.5. Average PE ratio historically is 26.5. So just based off that, they're undervalued. Price to sales only at 6.12 for a SaaS business, subscription as a service, which massive opportunity, massive consistent annual and monthly recurring revenue. Free cash flow margin is 41%, massive there. Analyst targets. The average analyst targets is $444.23. And like I said, they're sitting right around $350 today. Analyst ratings, buy. We have 5 strong buys, 19 buys, 12 holds, and 3 analysts saying sell at a 39 total analyst, right? If we come down here, if we want to run a sentiment analysis, we can run a sentiment analysis, see what everybody's talking about. Wall Street, slightly bullish. Retail, slightly bullish. Social media, slightly bullish. So this is much different than what it was. We're seeing a very strong uptick in bullishness around Adobe, which is why you've had this price moving higher recently compared to it was just down, 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 and down. We could have bottomed finally on Adobe. Time will tell, but I think we could have possibly bottomed. You can also look at investment thesis. It kind of gives you a little bull, bear, and fair value assessment. You look at risk assessment. You can run your previous valuations down here. This is a discounted cash flow model, but I'm going to do one better. Instead of looking at the discounted cash flow model or latest earnings or peer comparison, I want to go in here and you see we have DCF, EPS model, rule of 40, and PEG ratio, like top 4 valuation analyzers that people really like. And over here, you can see we have a compare tool, AI one-pager tool, financial charts, markets, what the overall markets are doing. We have a watch list where you can add things to your watch list, save it. You can have your portfolio in here, and just overall, I'm building this for me and I absolutely love it. You're not going to hear sale out of me. I built it for me. If you want access to this whenever I release it to everybody, I will leave the link down below and let you guys all know whenever I fully release it to everybody and make it accessible to all. First and foremost, High Five Collective members are going to get it though. So we come over here to all models, right? All models. Let's say I don't just want to do DCF or EPS or rule of 40 or PEG. I want to do all of them at the same exact time. So all we do is come over here to all models. We come down here and we already see that we're getting a strong buy based off AI synthesis and recommendation. But let's actually edit these, right? These are like where we're currently at typically right now. So 10.5% revenue growth over the next 5 years, at 41.4% free cash flow margin. Okay. So that means we're sitting at an intrinsic value of 480. And again, we're sitting at $350 per share today. $350 per share today. But on a discounted cash flow model, $479.86 is a fair value, 40% upside basically. Let's look at EPS. EPS, we're going to have to bring this down a little bit. I don't think they're going to be growing 40%. I think they're going to grow right around 15% EPS over the next 5 years, and giving them a PE at the end of that 5 years of 20, which is very fair. That currently sitting at 20 right now. There's a SaaS company. You can argue that they could, fairly get a 25 by the end of this 5 years, and that brings us up to 55% undervalued. But we'll just leave it right down here at 20. That is $425, 24% upside from here based on EPS model. Let's look at a rule of 40. Rule of 40, 10.5% revenue growth over the next 5 years, 41.4% profit margin. As of right now, we have a rule of 40 of 52, which is very healthy. Finally, our PEG ratio, which I think is the only spot that we will get dinged on. If we bring it down to a 15%, we're sitting right around, bring this down to 20. Let's bring it down to 20. We're sitting right at 1.33 fair value. Again, if we loaded this up to a 25 PE ratio, then we're slightly overvalued. But let's just leave it right here at a PE ratio of 20. EPS growth rate of 15%, and we're sitting at 1.33. So we can clearly see that based on all 4 of these, we're getting 3 of them that are telling us is a strong buy with an average price right around, I would say 450, which is $100 higher than where we are today. $100 higher than where we are today, guys. DCF shows 40% upside, significantly undervalued based on cash flows. EPS model projects 24% upside based on earnings growth. Healthy rule of 40 score indicates solid fundamentals. Yes, yes, and yes. 5 bullish, 0 bearish. Like I said, you can see it right here. Let's just say I want to save all models here. There we go. We can just save all models. And let's say I want to share this to X, or I just want to share it with my friends. I can copy the link to the site directly. I can copy it. I can download it. You see right here, we have, let's just say I want to share this in my community for Adobe. So I want to share this in my community for Adobe. I'm going to come here, bring that, and then I'm going to share this right here. Let me grab that again, copy. There it is, copied. And then I'm going to bring it over here, share it with my community and say, based on all metrics, Adobe is a screaming buy for me. There we go. And just share it just like that. Bam, there you go. Strong buy gives you all the price targets, the upsides, the growth that you put in, the PE that you put in, so on and so forth. So again, guys, I built this for me. I absolutely love this. I love building this website right now. I love this as a tool. And again, I can look at this for any company. I can compare companies. So let's say I wanted to compare Adobe with some of their competitors. Who are their competitors? Salesforce is a competitor. And then Oracle is a competitor of Adobe. So let's just say I want to, and then Figma too. Figma is a competitor too. So let's just say I wanted to look at all these. Look at this. You can see target upside by analyst, price targets, PEs, price to sales ratio, free cash flow margin, 3-year CAGR, 5-year CAGR, dividend yield. You can see all of it. Free cash flow. You can even see the analyst breakdowns, how many buys, how many sells, strong buys, strong sells, so on and so forth, and target price, the average target price. And then again, let's say I wanted to share it, boom, share it. And when you share it, this is the great thing. It gives you a little crown right above wherever it says whoever wins the most, right? So Adobe wins the most because of their PE, their forward PE, and their free cash flow margin. They get 3 bids where Fig gets 1 bid for upside. So based on the profit targets, which those are by analysts. So I mean, you got to take those with a grain of salt. But based on Adobe, CRM, Oracle, and Fig, Adobe wins based on valuation, stock comparison, and just is the better choice based on these factors, right? So again, I love this tool. You can run an AI analysis, a 1-pager. This is a really cool feature as well that I really like. So you can run an infographic. Infographic kind of tells you, okay, here's your targets. Here's the bull and bear thesis, growth, free cash flow yield, PE. And yeah, I don't know why it's saying hold, honestly, because that's a target of 400 to 450. So I think that might be wrong right there. It's okay. And then you can also do a detailed analysis where, say you're lazy, you don't want to do your own research, or don't have time like me all the time. You can just do this detailed financial analysis, and it kind of gives you executive summary, business overview, financial highlights, valuation assessments, bull case, bear case, verdict, and recommendation. Adobe Systems Incorporated is a strong buy. The company's robust financials, market leadership, and significant free cash flow generation are compelling. The current valuation provides an attractive entry point, suggesting a potential upside toward the analyst and consensus of $444.23 from today of $350. Boom. Love it. I freaking love this tool, guys. I made something for myself. I got rid of the pesky Excel sheet. I wanted to have my own financial, I want to have my own website or something to basically run my DCF. And I took that, and then I also added EPS, Rule of 40, PEG. So now I can basically do all my investment research, all my stuff in one place, my website that I made, that I pay for, that I pay for the data, all of it. I freaking love it. I love it. But anyways, that's Adobe. Earnings were knockout. That was long, I know, but we'll go through everything else. Everything else is pretty quick, honestly. So next thing was going to be Oscar. The state of Oscar. What is the state of Oscar? Well, the state of Oscar is this. Here's all the news articles, but I'll just straight up tell you. The state of Oscar is that it's December and the government still has not approved or began to approve or anything of ACA subsidies getting extended. They will die, ACA subsidies, not ACA like everybody believes. Everybody's like, what are they going to do without ACA? Affordable Care Act's not dying. ACA subsidies will expire if they don't get anything extended before the end of the year. So just make that very clear. ACA is not going away. It's just ACA subsidies will expire. They haven't done anything. It's been this bill, this thing, that thing, all of this like talk. And I've kind of taken a back seat a little bit. I have my positions built in Oscar. I made a post today on X and I said, Oscar is extremely volatile. This stock will not get out of this consolidation range until we get more clarity and we either get ACA subsidies to get extended before the end of the year. And then we will break out of this consolidation period and we will run because it's massively undervalued. Or we will not get ACA subsidies extended, which it might move down in the stock price a little bit lower. But then as 2026 goes along, and as the leadership said, they do not need ACA subsidies to survive or thrive. They will have to just prove it in 2026. So not getting ACA subsidies extended is going to be a dark cloud over the company until they prove it consistently in the earnings. Just like Adobe, or like the dark cloud is like AI is going to kill Adobe. Even though they've been proving it, clearly I haven't proved it enough. So Oscar might have the same fate in 2026, choppy, up, down, kangaroo, consolidation, until they really show like quarter in, quarter out that we didn't need ACA subsidies. We're still crushing in the ICRA market, so on and so forth, blah, 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 right? So the post I made today was basically this stock, if you believe in Oscar Health, if you believe in the disruption they're going to have on health insurance, if you believe in Mark Bertolini and his team, then it is a buy and throw it away in the filing cabinet and stop looking at the price action every single day, every single week. Buy it, have conviction, believe in it, not just for ACA subsidies. That's not my thing with Oscar. It never was my thing. I just strongly believe like, man, that'd be really, really dumb for them not to extend ACA subsidies because it's going to hurt a lot of Americans and they don't have a plan in place. Yet here we are, right? Only a couple weeks away from the new year and they still don't have anything done. So to boil it down to brass tacks, if they extend ACA subsidies, Oscar's going to fly, and 2026 is going to be a phenomenal year, and they are going to fly off the handle. If they don't extend ACA subsidies, 2026 could still be a good year for Oscar and a growing year based on the fundamentals and price movement, but they're going to have to prove it more and actually go out and prove it in earnings and show it consistently. So That's the state of Oscar. I don't feel like I have to talk about it every day. I'm honestly sick of all this back and forth between Congress and politics and stuff. It's really annoying. I still love Oscar. I still believe in Oscar for the long term. It's still number one right there next to Zeta, which brings me into Zeta. Zeta Global, phenomenal company. I recently did an interview with David Steinberg, the CEO. Before that, I went out to Zeta Global Live and got to see the team in action. Athena, which is their new super intelligent agent in action that's going to bring together One Zeta, their whole platform, and run it. And basically, now it's going to be any company out there. If they have a great product and a great company, but they don't have that skill of marketing themselves, right? As we all know, just because you have something great, you have a great product, you're a great person, you have a great personality, XYZ, just because you have that doesn't mean it's going to equate to business, to customers, to free cash flows, revenues. It doesn't mean that. You still have to sell your product. If you cannot sell your product, it doesn't honestly matter how great it is, because if you can't get it out there in front of the people's eyes, if you can't put it in front of the consumer or get your point across to other businesses why they need to use your product like Zeta does, because they're returning for every dollar spent by a company that uses their products, for every dollar spent, they're returning $6. $6 they're returning for every dollar spent. And they want to get that to $10 in the next couple years. Honestly, probably sooner than that. So what is Zeta doing for those people, for those companies, for those people that have those products that need to, they have the vision, they have the great product, they just don't have the marketing skills, they don't have the vision, or they don't know how to execute on the marketing standpoint. Here comes One Zeta, here comes Athena, bring it all together. Athena will allow the business with a great product to basically, like, Athena is going to be the painter of the Mona Lisa, and the business is going to be the brain thinking of the actual painting of Mona Lisa. So it's a great 1-2 punch, right? Because you can't, if you have a great business, some people just aren't great at marketing. But Zeta is bridging that gap and answering that calling to really fulfill that issue for those people, right? So for those people that have the vision of Mona Lisa in their head, but they suck at painting, Zeta, One, and Athena, that's going to run the whole thing, is going to come in and be the painter to their vision. I hope that makes sense. So really excited about Zeta. Yeah, Zeta is, it's so undervalued. It's a great company. I can run the AIs here. We're already running really long in this video though, so I'll say that for another video. But on X, I have posted about my investing thesis on Zeta and the fair valuation. They're currently right around $19-20 per share, and they should easily be a $30+ company based on fundamentals and where they're at. Besides that, there's some other things. They partnered with ChatGPT. We already know that from their last earnings. But now there's some rumblings that they may be doing something way bigger with ChatGPT. And yeah, if this ends up working out, it could be huge. Basically replacing SEO. So yeah, I got to make another video for that as well, because that's a deep dive in itself. But last thing I want to talk about here, guys, and again, we can look at Oscar today, 1.8% move. Again, year to date, we're up 16% on Oscar. Great. 6 months, 14%, 1 month, 7%. Last 5 days, we're down 8%. It's a crazy stock, crazy volatile. Like I said, if you just buy it and you believe in it, throw away in the filing cabinet, you're going to be just fine. It's in this consolidation range, guys. Until we get some news, it's going to stay here. Zeta, wow, it ended up break even on the day. 1 year, it's down 8%. Year to date, we're up 7%. 6 months, we're up 58%. So if you really bought that low here, where was that low? Wow, if you bought that low here at $12, you're sitting on cloud nine, up 50, almost 58% on the year. So massive there. But yeah, it ended up, it's having a really tough time breaking through $20 per share. It is what it is. Um, I don't know. It feels like something's like holding this stock down and it just can't break out over 20. But when it does on strong volume, it's not coming back. And we're going to see this thing continue to climb and climb and climb and climb back to all time highs, guys. Like, I'm so confident in this company, in this leadership, in David Steinberg as a CEO, in the fundamentals, in what they're doing, in the disruption that they have in the marketing technology industry to steal market share away from Salesforce, and Oracle's leaving the space, and even Adobe. I like Adobe, and I think there's room for all of them. But Zeta is the new guy in town, and they're coming in and killing it. Finally, Fluence Energy. Fluence Energy, guys. So if we go in here into our Discord, we pull up Fluence right here. There's a little form I have for all my gems. We were buying this name at $10.56 back in September 22nd of this year, just a couple months ago. And we bought it, we updated. I told everybody, hey, based on my DCF intrinsic value, EPS fair value, and that was from my Excel spreadsheet. And then I put it on this fancy little thing that I created in Canva. And now the great thing is I don't need this snapshot and I don't need the Excel spreadsheet anymore because I got valuesnapshot.io as my website that I created to give my DCF, to give my quick little share buttons, to pull all the data that I need. And I don't got to do all this hand jamming in Excel or anything like that anymore. So sorry, this might sound like a sale. And I'm like, oh my gosh, yeah, Value Snapshot's so great. I'm just honestly geeked. I'm so excited about, I never thought I could build a website, guys. I never thought I could build a freaking website. And here we are. I built a website just for me, based on my Excel spreadsheet, based on everything I've learned in this market over the last 10 plus years that I've been investing in it. Like, I'm sorry, it might come off as a sale, like, oh my gosh, you guys should try it. It's so great, blah, blah, blah. Like, I'm just really excited about it because you don't understand how much time it took me to update my massive Excel spreadsheet with all these different stocks. And now I can just go boop, 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 type in a ticker and then get like hours and hours and hours of freaking data and research and due diligence, all in clicks of buttons, And data is pretty cheap out there nowadays. So being able to get the data, it's not super cheap, but it's way cheaper than I thought it would be. So yeah, sorry guys, I'm really excited about it. But EPS fair value was $25. DCF fair value was $35 that I've been talking about. And this again was in the beginning of October. And then I gave charts and I gave more due diligence. I gave more analysis. And coming all the way to today, where we were sitting at from $10.54 all the way. Look at this. Hold on. Let's go. Yeah, I wish 6 months. 6 months would have been $5 and we'd be up 500%, but it's all good. $10. Where are we at? So $10 was right here. Look at that. 1053. I got the low. Basically got the low of this area right around in September. Right? $10.53 to a new all-time high. 8% today. 8% today. And I posted this on X. I didn't just post this in the Discord community. I also posted this on X. Again, I said it was originally a trade setup. I posted this right here. September 22nd, I said this is the next I have the next EOSE, BitF, Wolf, Iran, NBIS, Cypher, monster trade. And I posted it right here. The next monster trade, my high five algo indicators with my on my trading side of things, long entry right here. And I got in at like 1033 or whatever. And we were just rolling and flipping completely over. And again, you can see we were down here, now all the way up here, over $25. So absolutely crazy, guys. Just crushed it as a trade, but also crushed it as an investment. This thing is, it's a monster. It's a monster. We hit $25. So we're at our EPS fair value, which I haven't even reran the numbers, which I'll do with Value Snapshot. I'll probably do a deep dive on this. If you guys want to see a deep dive on Fluence Energy, I still think $35 is fair value based on DCF model. I haven't ran everything else. So if you guys want to see me do a video, like a deep dive, I'll do one on Fluence Energy, like why this is a great company, why I'm investing in it for the long term, why it's a gem, why I've been in this since $10 and some change, right? If you want that, leave a comment below letting me know, hey, do the FLNC, do the Fluence Energy deep dive, please, or whatever. Also, while you're down there, share and hit that subscribe button so you don't miss a video from me ever again. I'm going to be continuously using my value snapshot. Like, it's going to help me so much with my content as well, just making life easier for me and like making things like quicker for me to be able to do videos on, because I don't do scripts and everything for my videos. It's all impromptu, guys. Like, I impromptu my videos. I say, okay, I want to talk about Adobe, this, that, Oscar, Zeta, whatever. And then I just go and talk about it. Do I have fumbles? Do I mess up? Yes. But like, I can't read off a teleprompter. I can't read a script for crap. I'll jumble it. I'll mess it up. I'm way better at just being me, unapologetically me, and just talking about stocks, which is what I love to do. Like me and you are just sitting here as best friends, and we're just sitting down, having a coffee or something, having dinner, and then we're just talking about our favorite stocks, our analysis, our thesis, our due diligence. That's what I really want this channel to be about. Some trading stuff, but mainly this YouTube channel is about investing. My X is more about trading and investing, and posting both of those things. So that's what I really want this to be. So yeah, if you want that, drop a comment below, subscribe, like for more. All right, guys, I appreciate you all joining in, and I will catch you guys in the next one. Peace.